Thank you. Thanks everybody for tuning in and listening. I'm just going to start with the history of performance. You can see the performance is great over all time horizons. It's a little bit disappointing this year relative to competitors. I'm going to unpack some of that, and I mean, optimistically, some of the things that are responsible for that muted performance last year are actually turning around. So that should bode well for the fund in the coming year. What has worked for us, and here you can see the various sectors that the fund is invested in. So it's obviously quite diversified across many sectors, but you'll see the likes of diversified miners being quite a major contributor. You had a fairly strong commodity cycle. We think quite a lot of those commodities should continue to do well this year. We'll talk a bit more about that in some of the later slides. And then banks and industrials also certainly helping returns. And once again, also quite a lot of value in those sectors. And we still have a healthy exposure there. In terms of what weighed the returns down, our derivative position hurt us a little bit. So the way we hedge is obviously we buy protections for market falling, and the way we pay for that is we surrender some of the upside. So we forego some of the upside when markets are particularly strong. And the S&P 500 was especially strong in the last year, and so hence that did weigh a little bit on our overall performance. One other sector I should comment on is our offshore equity exposure. So we are far more positioned in the value side of the market, and we're quite underexposed to the more growthy sectors, the more expensive parts of the market. And last year was not a particularly good year for value. But we are seeing that turn now, and so that should bode well for the portfolio, which has quite a reasonable exposure in offshore financials and energy. Moving on to what we consider to be key themes that are obviously driving the way we have positioned the portfolio. We really think there are four key themes which we should discuss. I think the first one is one that everyone is well aware of. If you look at the chart, you can see the mortality rate in South Africa and the incidence of COVID, and this wave has obviously been quite different to the prior three in the sense that we've seen quite an infectious strain from Omicron, but the death rates have obviously been quite muted, and as for hospital admissions. So we think this gives us a little bit of an insight of what we would expect to see in the rest of the world, and we would think that we probably would have seen the worst of COVID by the end of this year. What does it mean for positioning in our funds? Well, a lot of shares came under huge pressure as a result of COVID, and some of those shares are not yet pricing in a normalization of economies. And examples would be some of our hospital shares, like a Mediclinic or a Netcare, where people obviously had to delay their elective procedures, but ultimately people will come back to hospitals, and that should obviously be hugely positive for the outlook for shares like that. In addition, there's shares like Bidcorp, which should also do well. That works they're in the food service side of the economy, and restaurants have obviously been under huge pressure. As people start going back to restaurants, we would expect a Bidcorp to do quite well. So just some examples of shares that suffered under COVID that should return to normality in the next year. The next thing I think I need to touch on are US interest rates and inflation. This is pretty much what you see constantly in at least the international news. If you look at the chart on the left, what you can see in light green is the inflation rate in the US, and it's obviously spiked to levels which we haven't seen since the 70s or the very early 80s. Now, we certainly expect that, and I think most market participants expect that to come down. The question is really how much and how long will it take? If you look at expectations of inflation in the dark green, what you can see is that expectations remain fairly muted. So they're very much in line with where they've been over the last 10 years. So over the long term, bond markets are certainly not pricing any risk of inflation. And we think that might be a little bit overly optimistic. And really the reason relates to the chart on the right-hand side, where you can see wage inflation and shelter costs. If you look at wage inflation, that's certainly been creeping up quite aggressively. It's over 4.5%. And wage inflation tends to be quite sticky because unemployment or employment levels tend to be quite sticky. And what's interesting is we correlate it with shelter costs or the cost of renting and owning a home. And you can see it's quite highly correlated with that. So if you expect wage inflation to be sticky, you probably would expect shelter inflation to be quite sticky. And that's a concern because shelter costs make up nearly a third of the US CPI. So very, very significant. And this could obviously be a problem, and it might outweigh some of the more temporary factors, which we think will obviously become less of an issue. So all your COVID issues around supply chain, blockages and high commodity prices, those impacts will certainly roll out and that could bring down inflation. But it's the more sticky elements that we are a little bit worried about that could be a risk to higher rates in the coming year. Other points to also comment on in terms of rates, obviously, if you break up a bond, you can break it up into an inflation component and a real component. And the real component is obviously comes through in the inflation in bonds, which we have in South Africa as well. And if you look at the chart on the left, you can see that real rates, or the rates you get on inflation-linked bonds, are actually negative. Now, historically, you generally don't have negative rates for any sustainable period of time, at least not in a normal functioning economy. So we think these real rates need to go back up to zero. We've already seen them move up quite a lot in the last week, which you don't quite see in this chart, but they've already moved from like -1 to -0.7. So we think that will probably continue in all likelihood. And the reason why we bring that up is we think that obviously has an impact on the valuation of equity markets. If bond markets are very expensive because real rates are low, investors will obviously look for value elsewhere and they will move into equity markets. The growth sectors of equity markets are particularly sensitive to bond rates in the same way that long bonds are more sensitive to long-term interest rates. Long duration equities or growth equities are also particularly sensitive to long-term interest rates. And you can see that benefit having come through, particularly in the growth indices. So you can see from the MSCI growth index that it's nearly 55% above where it's been in the last 10 years. And hence it's also no surprise that the S&P 500 also quite expensive relative to its history, given that it's a very growth heavy index. You've got a lot of those big well-known tech shares that make up sizable portion of the S&P. What's interesting to see as well is if you look at SA, we're actually trading at a bit of a discount, which is at the bottom of the table. So that really highlights the fact that there are opportunities in South Africa. And obviously that's why we have a reasonable selection of SA and domestically exposed businesses in SA. And just one final comment ties into what I mentioned earlier about us preferring the value side of markets more than the growth side of markets. I think that really comes through in the overvaluation that you see in the CI growth. So we prefer the likes of offshore financials, offshore energy shares that are trading below their historical levels as opposed to the more expensive growth shares. And we're starting to see that finally coming through this month as we speak. We've seen rates ticking up quite aggressively in the US, and you're seeing financial shares really doing well. A lot of the offshore banks, the European, UK, and US banks ticking up nicely. The second last theme that I'd like to discuss is China and commodities. So we've obviously seen quite a lot of action happening in China over the last year with this drive for common prosperity. There's been a hit to a lot of indices. Tech, obviously, very important to us in SA, given SA exposure to Naspers and Infosys. But we've seen other indices hit, like education, also taking quite a knock. One of the issues in China has been rapidly rising property prices for many years. It's made property quite unaffordable for the average Chinese person. So it's really been great for quite a small portion of the population. The government obviously doesn't see that as in the interests of the overall country, given property should be affordable to the average person. So one would expect property to continue declining as a percentage of GDP, and it's obviously an incredibly high level, especially if we compare it to other countries. And that's important because property growth obviously means demand for commodities. So if property is going to shrink, you need some kind of offset if you're going to keep commodity demand buoyant. The other factor also to bear in mind in China is obviously we've seen quite a major outbreak from COVID at the moment, and that will probably weigh on growth, at least in the next 2 quarters. All of this is obviously shown up in quite a hit to credit growth, which is what you see on the chart on the right, and that's the credit impulse. That often correlates quite nicely with commodity demand, and as you can see, it's at quite a low level. So we would think from this point onwards that would probably pick up. Why do we think that will pick up? Well, it really talks to what we've been hearing from the Chinese government over the last, particularly over December. They had their Central Economic Work Conference, where they actually prioritized economic stability. And they've mentioned that there will be a huge focus on infrastructure and green investment, and they're really looking to front load that this year. So we certainly would take them at their word. This is a year where we're having the 20th National Party Congress, where she will get voted in for an unprecedented third term. All these factors would suggest that China is going to need to show growth. And how will they do that? They will do that through stimulus, which will particularly go into infrastructure investments. So that's obviously quite supportive for commodity prices. The other factor that we think is supportive for commodity prices is obviously the move into more green energy, the move away from dirty energy. So what does this really mean? It means there will be a demand for base metals. If you look at the chart on the right, you can just see over the next 20 years, the multiple of demand that we will have for various base metals, which are used in obviously EVs or growing power grids or the other specific types of green energy, whether it's wind and so on. So certainly a lot of there are quite a lot of factors that are driving the demand, particularly for base metals, which is why we like our holding, or we have a holding in Glencore that has quite a sizable exposure to base metals. They're also benefiting from the exposure to coal. There's obviously going to be underinvestment in coal as the world tries to wean itself off dirty energy. So that should certainly be beneficial for the coal players, at least over the medium term. And then finally, just a comment on South Africa. I think it's fair to say that the growth outlook for SA is fairly muted. Once we've sorted out COVID and we've seen the worst of that, it's pretty much going to be going back to where we were prior to COVID, which was a fairly muted outlook. For us to get a bit more optimistic on SA, we'd really like to see some moves on infrastructure and fixed investment, particularly in the power side. That doesn't quite seem to have gained traction, so we'd like to see that happen before we get more optimistic. And obviously, we'd like to see some prosecutions from the Zondo report as well to also increase some of our optimism on SA. In terms of external factors that are impacting us, we obviously benefit from this buoyant commodity environment that we're in, so that is positive. Against that, there's obviously the worry of rising rates globally, and that tends to be a bit negative for emerging markets, not just South Africa, as you often have outflows from them. So that's a bit on the negative side. So those two balance each other out. Really, the key to take home here in terms of SA exposure is you want companies that are not overly exposed on domestic economic growth. In other words, you want companies with a bit of self-help, or you want companies that are cheap, that aren't pricing in a buoyant environment in SA. In terms of the various sectors or particular shares that we'd want to be invested in, on the self-help, there's the likes of Investec and Momentum. These are two companies that have really been fixing themselves up. Investec has been an underperformer for many years, and finally in the last year we really are seeing a fantastic improvement there. Looks like they will be covering their cost of equity for the first time in the bank, which is obviously very positive. They trade at a reasonable discount to book, so we should get some upside there. And we've seen Momentum regaining market share over the last few years, and that should hopefully continue to drive our performance from that share. Remgro is a bit of an unbundling story where they are just disposing of some of their listed holdings, like NMI and RMI and so on. That should obviously be positive over time. We should get an unlock of that discount. I've spoken about the COVID recovery shares. These were the shares that really suffered under COVID. That should be fine once the pandemic is behind us. There's obviously quite a lot of value in the SA market that I mentioned earlier. BTI is obviously one that will often come up, and we've seen a fantastic realization of some value in BTI this month already. That was trading last year on dividend yields of 9%, which we just think was excessively cheap. And then in financials, Absa is particularly cheap. It's trading on less than a 7 PE and a dividend yield of close to 8. You really don't need much earnings growth to get a decent return out of a business like that. If you're on a dividend yield of 8%, it essentially means even if you grow your earnings at less than inflation, you'll get a double-digit return. Astral, another example of a cheap share. Telkom should also hopefully benefit from some kind of realization of value from their towers business, and then mining and resources, which I just spoke about. I spoke about Glencore. Impala is another business that's trading on a very low multiple. It's still going to be some time until EVs occupy the full car park. It will probably take some time, particularly for emerging markets, to have a full car park of EVs. So there's still going to be a demand for auto catalytic converters, as you're still going to have diesel and petrol cars for quite some time. And I think Impala should certainly benefit, and their cheap valuation is also obviously quite compelling. In terms of what this all means for the portfolio, you can see this gives us quite a diversified spread of assets. You can see the two hedges that I spoke about. We do think markets are a bit expensive overseas, and so we have maintained hedges in the portfolio. They might suffer a bit if markets run aggressively, but they'll certainly be beneficial if we see a bit of a hiccup in markets, which we might see in the next year or two. That is my story. Thanks very much.
Thanks a million, Saul. Really appreciate your presentation. The audience have come through for me, and I've got the iPad working. So the first question was actually on the PGM basket around for clean energy going forward. Will the PGMs see any benefit here? You mentioned, I guess, the transition in terms of energy, holding the likes of Glencore. I think they bought Anglo American's coal assets. And I think it's a recognition of where the world is going, but there is a transition period. And as people are turning their back on coal, it doesn't necessarily mean it's lost its place. And I think that's where Glencore comes in and serves that sector of the market. But going back to PGMs, I mean, platinum typically, I guess, in your sort of converters and your combustible engines as we move to electric vehicles, etc. Where do you see PGMs, I guess, more on a macro level with regards to the clean energy movement?
Right. Okay. So I think, first of all, it's obviously going to take some time to get the car parks fully in the EV space. We're not seeing much investment from the PGM miners. So we certainly think there's going to be demand for some time for palladium and particularly rhodium. So we expect there to be deficits, and we think those prices should be reasonably well supported over the short to medium term. Over the long term, there certainly is a lot of investment and IP going into platinum. So that over the long term could certainly be there certainly could be demand, particularly on the fuel cell side, and we're seeing a lot of industries investing heavily in fuel cells, and that's more of a long term thing. Quantifying that at this stage is obviously quite difficult, but we certainly think there's quite a lot of optionality in the platinum side of the basket, and as you know, that's by far the largest portion of the basket for most of the PGM miners.
Yeah, I think we often fall into the trap of, when we talk about the PGM, focusing a bit more on platinum, but obviously there's the rhodium and palladium, etc., that do behave slightly independently. One last question from my side. My colleagues in Johannesburg will be incredibly chuffed to see, I think Nedbank might have been added to the portfolio recently. Would that fall more within, I guess, your local value or your kind of COVID recovery type stock? I mean, it is a small position, but maybe just some general comments on financials in South Africa in general, and seeing through COVID as it moves more to something more endemic as opposed to pandemic.
Sure. So I mean, there's actually a lot of crossover. You know, I spoke about things that will benefit from a return to normality post COVID, and I spoke about value. But most of those shares that are recoveries are actually cheap as well. So I mean, you mentioned financials. So financials have suffered. They've obviously had, and they've particularly been hit by not just fairly muted loan growth, but by credit loss ratios that should obviously normalize over the next year or two, and dividend payouts should normalize. So to an extent, yes, there certainly are recoveries from COVID. Over the long term, we are concerned about loan growth from SA financials. So we don't like them because we think there's a lot of organic growth in them. But we think they are particularly cheap, and I mean particularly the likes of an ABSA, where we do have quite a sizable position trading on an 8 dividend yield. Even if you have fairly muted loan growth, you really need about 3 to 4% growth in your earnings, which should give you similar growth in your dividends, which should give you a double-digit return, and we think that's compelling. And you're seeing that in quite a few of the financials. You're seeing that in the insurers as well. But in terms of self-help and a real recovery, other than just a move in credit loss ratios, we probably look at the likes of an Investec, where we really are seeing a major change in their business as they move from being a business that generated sub-economic returns to one that actually covers their cost of equity. So that's probably where we see the biggest improvement. And ABSA, it's probably more at the margin where we've seen them cutting their costs, and they do certainly appear to be getting loan growth that is above market. So they're getting some market share. We need to see how profitable those loans are. You obviously only know about that after the fact. But as a general comment, we'd say most financials are cheap, and I'm not discounting too much optimism in terms of SA economic growth, which is important since we think the environment will be muted going forward at this stage.
Excellent. Thank you very much. So unfortunately, that's all we have time for today. I was going to pick your brain on China. I know you're the Ping On insurance guru, but I think you covered China at reasonable length. You also covered US inflation actually quite nicely. I mean, we focused quite a lot on the energy prices, but I really enjoyed your chart looking at sheltering, or at least, housing costs, etc., and how those two can kind of offset or play against each other in terms of the inflation expectations and the read-through, of course, for the Reserve Bank there. But Saul, thanks so much for joining us, and we look forward to catching up with you soon. Take care.
Thank you. All the best.